Hello and welcome to today's podcast. I'm Susan Guthrie, your host. And today I've got a treat for you because I have one of my local friends visiting with me, one of my expert professionals here from Chicago. Tami Wollensak is here with me, and she's going to help us walk through what I know is an issue for so many of you who are listening. And that is you want to keep the house in the divorce, but you don't know what that involves. And the reason I asked Tami to come in and talk about this is because this is really her area of expertise. She's a licensed mortgage loan originator. For those of you who don't know what that is, promise you, we will talk about what that is. And she's also, importantly, a certified divorce lending professional, which we will also unpack for you. But it really gives Tami a special understanding of what you are facing when you want to keep the marital home in a divorce, and the lending and all of the permutations of the difficulties that can go along with that. So first, let me just say welcome to her and thank you for joining us, Tami.
Thanks so much, Susan. It's a pleasure to be here. I appreciate it.
Well, and I appreciate your making the time to talk about this issue because I have to tell you, the marital residence and what's going to happen with the house is probably one of the first questions I get when I meet with clients, whether it be mediation or as a divorce attorney. It is usually one of the biggest, if not the biggest, assets of the marriage. And very often that mortgage is one of the biggest debts in the marriage. So it's
Absolutely.
a right, it's a
Yeah,
toughie for
absolutely.
people.
Yeah. hmm I think people are very emotionally tied to their home, rightfully so, right? They've built a lot of memories in the home, and they have a lot of history in the home, and I think that's a lot of times something that people really want to hold on to, and so they're really just because it's so familiar to keeping the house is a big issue.
Yeah, I hear that a lot, and I hear it in the context of wanting to keep the home base for the children the same. It's where they've, put their heads on pillows for years. It's where they go to school from. It's often a place that people have put a lot of blood, sweat, and tears into, both financially and personally, decorating and painting and doing repairs, etc. So it is something for many people that's an emotional aspect of divorce, among the, as we know, many emotional aspects of divorce. But there is a very real financial component to keeping the house, and many people don't put a lot of thought into that until it becomes too late. They go along in the divorce process. They're like, oh, it's just the number one thing that I want is the house out of the divorce. And there's so much they need to think about, and there's so many complications that's what I want to talk about today. And I appreciate your coming to discuss this. We're going to kind of hone in on the situation where we have one of the parties who really wants to keep the house,
hmm
but they find themselves struggling because there's a large mortgage on it. There can be a large amount of equity that perhaps their spouse would be entitled to. And very often, when we have either someone who has stayed at home to raise children or who has not pursued their career to the extent they might have, their income might be an issue. So we'll unpack all of that. But before we do, I promised people that we were going to talk about what a licensed mortgage loan originator is and what a certified divorce lending professional designation means. So if you can
Yes.
help us start there.
Sure, absolutely. So, a licensed mortgage originator, in that field, we have to be licensed. We are regulated heavily by the National Association of Regulation for Mortgage Lenders. We have to go through testing, and then we have to go through we're in a database basically. So we have to have certain things that we have to adhere to, compliance things that we have to adhere to. We have to make sure that we're disclosing certain things to clients in a timely manner. We have to use certain language, and we have to be clear and concise when we're talking about mortgage lending to people. So it's really important that you're talking to a licensed mortgage professional, because you want to be able to get the correct information. So I've been a mortgage originator for several years, but I've been in the mortgage business for 30. So,
So you're like
and
me as an attorney,
yeah,
30 years. Yes.
yeah,
Well, and
yeah,
it sounds like licensure, much like attorneys need to be licensed, is for
yeah.
the protection of the consumer.
It's a consumer protection. Yes, exactly. So, if there's ever any um, things that are done improperly, it goes against your license. You don't want to lose your license. I mean, basically, you're out of the business if you don't do things properly.
So, and then I know you've gone that step further and gotten the CDLP, Certified Divorce Lending Professional designation, which is
Yes.
extremely helpful, obviously, in this field.
Yes. So the certified divorce lending professional, what I like to tell people is I really wanted to understand the process of divorce. So I wanted to understand what that looked like so that I could help people navigate it. Because as a mortgage professional, we know how to do a mortgage loan, but a lot of times it doesn't tie to the divorce. And I was getting clients coming to me post divorce with their settlement agreements and saying, guess what? I get to keep the house. And I'm like, guess what? You can't, because like in the mortgage world, there's a big gap there sometimes. And I can help fill those gaps if I can get to people at the very beginning of the process and do what I call divorce mortgage planning, right? We come up with solutions and options for the client to make sure that they make a better informed decision when they're going through their negotiations. They can't just sign the settlement agreement. I mean, that's, you're inking something that's like court ordered, right? And then you are not able to fulfill it post divorce. That's not a very successful negotiation. So if you come up with the options for the client up front, then they can go into it and decide that they may not want to keep the house, or they may want to keep it, but they have to negotiate some of the equity situation in a different way, because they might not qualify for the whole thing that they need to do. So coming up with all their options just helps them make a better informed decision.
Right. Well, and that's exactly what I want to talk about today, because for so many people, as I said at the top of this episode, they come through the door or they walk into the divorce negotiation, whether it's mediation or through their attorney. And what they have in their mind is, I want to keep the house.
Yes.
Right. And what is involved in that is so much more complicated than just, I'm going to stay in this house. I'll take over paying the mortgage. You go away, which is
Yeah.
what they think of their spouse or their soon-to-be
Right.
ex-spouse.
Right.
And boom, we're done. So
Yeah.
that's what, why I think bringing someone in like you is not just optimal. It's actually necessary, because you've pointed something important out. If you make an agreement in your settlement agreement that you are going to say, keep the house and do certain things, be responsible for the mortgage, pay out the equity or the half of the equity to your spouse, whatever those things are, you have to know that you can do those things.
Yes.
Or you are putting yourself in a precarious position post-divorce. So let's break this down for people, because I want to you'll be surprised, or maybe you aren't, because this is what you do. I find a lot of people don't even understand, what equity is,
Yeah.
what the mortgage is, and how that works.
Yeah.
So maybe just in simple terms, talk about,
Yeah.
the equity, how you calculate equity in a home, and how the mortgage actually works for people.
Yeah, those are all great things to explain for sure. So on when you have a mortgage on a home, there's what you owe on the home as opposed to what the value of the home is. And you can calculate the value several ways. They can be you can go out and get what's called a CMA, which is a current market analysis on the home, and that's maybe what a realtor might do for you, and they might project what you can sell the home for based on, what's going on in your neighborhood, in your marketplace, based on the square footage of your home, those type of things. Or you can get a residential appraisal done, and an appraisal looks at the past. It looks like what's sold in your area, sold and closed in your area, and what those sales are that are comparable to your home. So that those would be two ways to get the value of the home. So you have the value of the home, and then you have the balance of your mortgage is, and what's in between there is what's called the equity. So that's the equity in the home. That's the difference between the value of the home and the mortgage on the home. And a lot of times, in a marital home, that equity is divided equally. A lot of times, you half the equity is yours and half is your spouse's. So when you say you're going to keep the home, a lot of times in negotiations, what happens is you have to refinance the home. And what that means is you have to get a whole new mortgage. Your mortgage is not the way your mortgage looks today. And a lot of times people come to me and they're really excited because they have, 2.5% or whatever they got over the last few years. Rates were at an all-time low. Lots of people refinanced. So their mortgage rate is great. They think, oh, they look at their mortgage payment and they go, oh, I can handle that. That's, I can cover that. But that is not what your new mortgage payment is going to look like if you are awarded the home and you have to pay your spouse half of their equity. So in order to do that, what you have to do is you have to take the current mortgage plus half the equity. And for like simplistic terms,
I'm going to stop just because I think we're getting a little
going too far in the
complicated.
weeds. Okay.
I just think we've gone, further down the road than I think would be good here. So I'm going to take it back I'm going to pause for a minute just so that Darlene knows that we're breaking. And I'm going to take it back to where you described what equity is.
Okay.
And I'll say, so I'm going to pause. So that's such a good point that you've made, Tami, about what the equity is, because I'll tell you, I've seen so many people come through the door with an idea that what they purchased the house for is what the value of the home is. And as you've just, correctly pointed out, value of a home will change as the market changes over time. So you've talked about getting an appraisal or getting a CMA to set the value at the time of the divorce, right? You have to know what your home is worth when you're going through the divorce. And that may not be the purchase price. If you bought your house many years ago, I can almost guarantee it's not the purchase price. So you're starting with kind of what we call the fair market value, right? What's your house worth today? And then, as you said, you subtract out the current amount of what you still owe on the mortgage. And that's the same, right? It may be a different amount than your original mortgage amount. You may have originally, when you bought the house, gotten a mortgage of 200,000, but you've been paying it during the marriage. Right. And now it's 150.
Correct. Yes. So there's a difference between those two numbers, and that's what your equity is. And that's a marital asset. The equity in the home is a marital asset. So that could be a significant number in some instances.
I mean, we've certainly seen different things over the years, right? In the late 2000s, 2008, 2009, we saw a lot of situations where, in fact, there was no equity in the home, or in fact, it was underwater. But more often these days, what we see, I'll give an example. A house that has a fair market value of $400,000, and there's still a $200,000 balance on the mortgage. So the equity in that particular home would be $200,000. And, that would need to be divided amongst that couple in some way, often 50-50, as you said. But the other complicating factor that I think people don't realize is that mortgage, because that mortgage is usually held by both of the people who are in that marriage, right? And if one of them is going to keep the house, what happens with that mortgage?
right? When one of them decides to keep the house, the other person more than likely does not want to be tied to that mortgage post-divorce because it's also tied to their credit report, and their credit and their ability to go out and buy future homes. So most of the time, what happens is that person that's keeping the house has to refinance the home in just their name alone and qualify in just their name alone and remove the other spouse. It's just called the quitclaim deed. So the other spouse basically gives up their ownership in the house by this other person doing what's necessary to keep the house.
Yeah. And that's something, and I think this is the biggest area where people do not understand, that if there's that, I'll use our example of $200,000 in equity in the home, and you want to keep the house. What you have to do is figure out two things. One, how you're going to get your spouse their roughly $100,000 in equity, the money they are due out of that asset. And two, how you're going to get their name off the mortgage. And that's complicated. And as you've pointed out, the number one way I think that we do that, or we see it done, is the person who's keeping the home goes and gets basically a new mortgage. They go get a mortgage in their own name that pays off the $200,000. But now they've got a debt in their name of $200,000. But it's more complicated than that. I feel like, but wait, there's more.
Yes, exactly. It is.
How does someone, and I referenced, a mythical person, but who might be my, people who are listening, someone who doesn't have a lot of income of their own, maybe has been a stay-at-home parent, or who has not really pursued their career, so they'd have more availability to raise the family during the marriage. So now they need to go out and get that $200,000 mortgage or whatever it might be in their case. How do they do that? What's involved?
Well, they have to go apply with somebody like myself, and we have to start analyzing, if there is an income stream, maybe there might be part-time income that they might have worked a little bit or part-time, but just because you have income coming into the home, into your bank account, so to speak, does not mean it's what we call in the mortgage business qualified income. And qualified income means it has to have a history of it has to be consistent, and it has to continue. We have to know that it's going to continue. So let's say there's no income. Let's say there's no job. That's been a stay-at-home spouse, and they've been taking care of the children. They have not worked outside the home. In that case, a lot of times they have to qualify using maintenance that they might be awarded from the other spouse, right? They might be awarded income that they're going to be receiving from the other spouse to kind of equalize their income and to be able to take care of the mortgage payment and all the other things. So we can use that maintenance or that projected maintenance, but we kind of need to know what those numbers are, and it has to be received for a certain amount of time. So you need receipt of that for typically 3 to 6 months, depending on the mortgage program. And we need to show that there's receipt of it, and then we need to show that there's a continuance of it. So that's where it gets super complicated, because sometimes part of that might be child support. You might have children that are, let's say, 16, and you're going to only get it till they're 18. In the mortgage world, you need a 3-year continuance. Well, that's only a 2-year continuance. I cannot use that in the mortgage world as income. You might be getting it today and say, but I'm getting this amount. I'm sorry, you cannot use it to qualify to keep the house. So lots of moving parts and a lot of things to take into consideration.
That is such a great point, Tami, about maintenance, or for those listeners who are in other states, alimony, spousal support. But here's a point I want people to understand, because you mentioned earlier how important it is to get involved and working with someone like you early in a case. The 3-month period that you mentioned, or 6 months, or whatever that lender is looking for to see that spousal support or maintenance or alimony coming in, that can be a temporary order that starts during the divorce process. So the earlier you start working with someone like you who can
Mhm.
let someone know what type of income is needed, start building that, income stream, and go to court and get those temporary orders in place, that can actually start your process right in the middle of the divorce process, rather than what you talked about earlier, someone who comes to you with their agreement after the divorce is finalized. So I think that's a really critical point. You want to start thinking about what the support stream looks like if you're going to be receiving alimony or support early on in this process if you want to keep the home.
Absolutely. You need to know kind of, even if you don't know precisely what the amount is going to be, you can start that process, and then that's what starts the clock running, so to speak. So if there's a temporary order in place, the what I call the out spouse, the spouse that's leaving is paying, the spouse that's keep staying a certain amount of money. It's from their individual account to another person's individual account. It can't just be voluntary. If even if they are paying it, it needs to be documented, so to speak, for mortgage purposes. And that's the only really way to do it, is that it's court ordered. You're paying from an individual bank account to another individual bank account, and can't have commingled, so to speak, funds in like a marital account that's just being transferred or something like that. Then you're just transferring your own money to another account. So
Right. Well, and I know that often for these mortgage applications, ultimately what a bank is looking for is a certified copy of the judgment that
mhm.
says this much support's going to be paid and this is how long it's going to be paid for, to meet those sort of hallmarks you were talking about of
Mhm.
amount and duration, right?
Absolutely. And it's really important that we know, even that you know that it's going to be a 3-year continuance, because sometimes you can negotiate maybe even a smaller amount so that it continues for a longer period of time, just so that you can qualify. But knowing that up front so that you can make those decisions, maybe that's not an option. Maybe it is what it is, and it's only going to happen for a certain amount of time, period. And then it can't be used, and then it can't be used to qualify you. So we need to switch gears and do something else.
Well, that's such a good point, because people can switch gears. That
Mm-hmm.
isn't the only potential option. Other things I've seen people do are get a co-borrower as a
Yeah.
family member, sometimes their parents or a
Mm-hmm.
sibling who is willing to co-sign on, who has an income stream that might qualify. Is
Mm-hmm.
that something that you see?
I do. I see that. I see that where, there might be a mom or a dad that's willing to go on the house for a certain period of time, just until that person gets back on their feet, and there's a ability to take the parents off of it, but at least it's on their side of the fence, so to speak. And then the other thing I've seen is, if there's a lump sum distributions, if you can get to them before, if there's just a pot of money, so to speak, being awarded to the in spouse, we can take that money and put it in a revocable trust, and it can create an income stream. But only if we get to make those decisions before you sign on your settlement agreement can a lot of these options happen.
Right.
So we can create income streams out of kind of nowhere, so to speak, if we have the opportunity to kind of look at what's being awarded to you and what's happening.
Well, it's part of, that I always talk about on the show, the team approach to divorce. And really, you're another team member who helps with the option generating and helps with the brainstorming. We were just talking, right here about different ways that you can make that income stream work as at, to get the loan from your lender. But
Yes.
the other thing that you need to be able to do is figure out where you're going to come up with the equity to pay out your spouse, right? The out spouse, as you
Yes.
referenced them. And
Yes.
so in the example I gave of a $400,000 home, or fair market value of a home, with a $200,000 current mortgage on it, that person might owe about $100,000 in equity. And this can be complicated when it rolls into this refinance, right? Maybe you can explain that.
Yeah, so what that's called in the mortgage world is an equity buyout. And if it's spelled out specifically in your settlement agreement as an equity buyout, then we can consider it a rate and term mortgage. So it's not, a lot of times people think it's a cash out mortgage that you're taking cash. And the difference is in between a cash out and a rate and term mortgage are the terms. You get the best terms if it's considered a rate and term. So we can take, and it also allows you to have the ability to access more equity of the home. If you're doing a cash out mortgage in the mortgage world, you're capped at 80% of the value. You cannot take more than 80% of the value of your home in a cash out situation. If you're doing a rate and term refinance, you can access up to 95, sometimes 97% of the
Wow.
value. So it gives you more access, it gives you the best terms, but it has to be spelled out in your agreement and you have to qualify to do that.
Yeah.
So now you have to qualify not only for 200,000 but 300,000. So your new loan's 300,000. That's what your new payment's going to be based on. That's what everything's going, so you can't just look at what your payment is today and be like, oh, that's good, because your new payment's going to be what the new terms are, meaning what's the rate in the marketplace that you're refinancing in. Well, if you have a rate that's 3% because you refinanced two or 3 years ago, and now you're trying to do it today and rates are 5.5%, let's just say on average, your payment's going to look a lot different than it does today. And you have to be ready for that or capable of making that without it, being a stressor on you. I think that's where people, they want to keep the house and then they realize what the mortgage payment's going to look like. And then they're like, wow, that's a lot, because that's not what they're used to paying anyways.
Right.
That wasn't what they were used to paying. So it could be double of what you're used to paying.
Well, because I mean, you've made so many great points right there. We, in just the past year, have seen mortgage rates just skyrocket to one of the
Right.
highest interest rates. I think we are over 5.5% on average right now for
Mhm.
30-year loans. And not that long ago, really, we were in the 3% range. Now, that may not sound to listeners like a huge difference, 3%, 5%, what's the big deal? It can
Yeah.
be a very big difference when you're talking about these hundreds of thousands of dollars loans.
Yeah.
And let's not forget that when you take over the house, you also take over all of the expenses of the house. And the first two I want to talk about are the fact that the taxes and the homeowner's insurance become your responsibility. And
Yes.
they might change as a result of this refinance and the fact that now title's only going to be held in your name as well, right?
Yeah, that's a really good point. And I really have people that want to keep the house consult their insurance advisor, right? Because when you're going out to get insurance in just one person's name, a lot of times insurance brokers, what they do when they price out insurance is, you get group discounts. You might have multiple cars, you might have, the house and different things that come into the package, so to speak, and be priced that way. Well, one spouse is leaving, they're taking their car with them, and they're going to insure their car on their own. Maybe they had better credit than you had, and the insurance was underwritten based on their credit score. Now you're having to get new insurance, so your insurance might look very different, in addition to the mortgage payment looking very different. So the only way to make these decisions properly is to do it before you sign your settlement agreement and know what all the pieces of the puzzle are, and know exactly what your mortgage payment's going to look like post divorce. Because otherwise you're just it's just a guess.
It's just a guess. And if you're guessing based on history, it's not a very good guess,
That it's
is
a
what
very
I'm
bad
hearing.
guess. It's a
Yeah.
very bad guess. Yes.
Well, and that's something I bet a lot of people didn't know, is that your insurance rates for homeowners and car insurance can be impacted by your credit rating. And I don't think a lot of people understand that.
Yes, it can be. It's basically underwritten when you're going to get a new policy in just one person's name, because they're assessing the risk of just that one person. So credit scores are very, very important. And that's why it's really good too. Annualcreditreport.com is a source that I like to give out, where people can take a look at their credit report. It's free. It's a free service. You can go get your credit report. You can get all three bureaus of your credit report, and you can see exactly what's on there, and you can monitor it, especially when you're going through a divorce. Sometimes people miss payments inadvertently, sometimes on purpose. So you really want to monitor it during the divorce process and make sure that you understand exactly what's on your credit report and how things are progressing as you're going through the divorce.
Yeah, because the credit is one of those areas, and this is probably another episode I should be doing. So I'm going to put this on my list. But credit is very often negatively affected during the divorce process for a variety of reasons. And actually, this brings up for me another question for you, because I see that this happens often. Do you see cases where somebody they're going to start working post dissolution, or they may have started in a new job or taking on new job responsibilities because they know a divorce is coming? And so,
Yeah.
although they don't have the 3 years of anticipated maintenance or spousal support coming, they do see an income stream that's going to increase through their own work efforts.
Mm-hmm.
But so the parties explore this idea of refinancing down the road. They give
Mm-hmm.
it some time, like the out spouse, as you called
Mm-hmm.
them. I like that term.
Yes.
The out spouse will stay on the current mortgage for a while to
Mm-hmm.
give that other person, the person who's keeping the home, a chance to build up their
Mm-hmm.
ability to refinance. But now we're in a complicated situation, right? Because now there's a mortgage payment that's in both their names that needs to be paid, and perhaps taxes and homeowners insurance and
Yes.
all
Yes.
of that. So what do you see with that sort of a situation?
Well, I think that that's a a slippery slope to go down, because the person leaving the home, if they're tied to the mortgage payment and for some reason inadvertently, or, maybe things something else comes up and a mortgage payment gets missed, both credit reports are impacted, and it can be impacted significantly with with a missed mortgage payment. It can drop scores hundreds of points. And then that person that is going to refinance the home down the road with very good intention to refinance the home down the road might be thrown out of having the ability to, just because of the credit situation. So not only their income situation is tied to those decisions, but also their credit is tied to those decisions. So it's really important that your credit report, and if your credit is not up to speed, so to speak, to get it there, like to work on it, to like know what's on there. Maybe there's a small collection or something that you didn't even know was on there that you can easily take care of. But sometimes with credit, it's time too.
Yeah, it takes time
It
to
takes
fix it.
time. Yeah.
Yeah. Well, and you
So
make a good point that not both parties' credit in that situation can be impacted. I've seen clients who, for their personal reasons, maybe they want their kids to be able to stay in the home, but their ex-spouse is not able to refinance right away. So they say, "Sure, I'll stay on the mortgage for a year, but he or she has to pay it and be fully responsible." But something happens, things have, some people are just not good
life.
at paying bills, all the way up to they get sick and they're not making money or whatever happens. And when that payment doesn't get made, as you just said, it's going to hit that person who was being good or trying to do the right thing, just as hard, if not harder,
Yeah.
because the mortgage payment didn't get paid in a timely fashion. And there's
Right.
no fixing that by saying, well, it was my ex-wife or my ex-husband's responsibility. I'm sorry, I've not ever seen that explanation get a negative mark taken off of someone's credit report.
Never. No. It's just now it's absolutely time. There's nothing you can do to correct that. I mean, you miss a mortgage payment and it goes 30 days delinquent. On the 31st day of delinquency, it hits your credit report and it'll drop your score significantly. It not only impacts your ability to refinance mortgage wise, but it impacts everything that you try to do. You try to go out and get a car loan now, problem. You try to get a credit card, there's a problem.
Yeah.
You know, everything that you try to do credit wise is tied to your credit report. So it's like almost the most important thing that you should really pay attention to is your credit report.
Yeah. I do want to get a little tip for those who might be considering that situation is we've always put language in our agreements when someone is staying on a mortgage for a time period that if the person who's responsible for the mortgage payments during that time period is unable to make a payment, they immediately notify the other person in advance of there being, you know, it being late. So at least that person can make the payment if they have the means so that they can protect their credit score, because frankly, that's all that's available to that person to try and protect themselves.
I would also add to that, Susan, that what they can do, the out spouse can also request from the servicer a duplicate copy of their mortgage statement, so it can be mailed to their home as well. So they can get a duplicate copy every month, just like they were living in the home and getting a copy of their statement. Probably more email to them or
Right.
digital these days, but they can request that from their servicer. So they know exactly what's going on with that mortgage and that mortgage payment as well.
That's a great tip. And that's a tip where self-help is going to be your best friend in that situation so that you're monitoring whether that payment got made. And God forbid, on the last day possible, if it hasn't been made, you may want to make it to save your credit report.
Oh, absolutely. You would definitely want to
Yeah. And it's worth it. And that doesn't mean that the other person who was supposed to make it doesn't now owe you that money, but at
make it. Right,
least you've protected yourself. And
right.
then there's one more aspect of this whole refinance, keep the house, mortgage payments, et cetera. And we've sort of talked about the fact that there are other payments that go along with home ownership. It's really important if someone's planning on keeping the house, on going through this refinance, on paying for all of these things, that they make sure that their budget going forward is actually going to cover, because it's not just the mortgage, the taxes and the
No,
insurance, is it?
no, it's not. I mean, this is something that I went through personally, so I'm pretty um, passionate about explaining this to people. Is it's really just not just the mortgage. There's a lot to home ownership. You have to keep, you know, things working appropriately. Sometimes you've lived in the home for 10 years and now all of a sudden like you need new appliances or you need, you know, things repaired that were in distress, or you might need a new roof, God forbid, you know, or stuff that's really a large ticket item. So I always say, you know, if you're going to decide to keep the house, make sure you get an inspection done, just like you were if you were going to go out and buy a new home, so that you're fully aware of what you're signing up for. If you get an inspection done, it's going to cost you, you know, $300 or $400, I don't know, depending on where you are in the country. But if you then find out that you have, you know, water damage somewhere that you weren't even aware of, or something wrong with plumbing, or something wrong with your roof, or something wrong that you really didn't even understand, you're the one signing up to be responsible for that. I mean, it's your responsibility by keeping the house.
Yeah, you know, I've never heard anyone say that. Get a home inspection at the time of the divorce, but it makes so much sense because you are actually buying a house at that time,
Yes.
really. It may be a
Yeah.
house you know.
Hmm.
And I see that as being significant in two ways. One, it may affect the fair market value of the home, right?
Yes.
The if you need a new roof, which by the way is a $15,000 to $30,000 expense for most homes, or a new
Yes.
furnace, $5,000 to $8,000, or whatever it might be, and that wasn't taken into consideration in the CMA or appraisal, it may affect that fair market value, which affects the buyout figures, et cetera. And that is something that you, just as a homeowner, you need to be aware of. So I think that that's an incredibly important tip for people that they wouldn't have originally thought of, because home ownership, I know myself, you mentioned you've been through it. I went through it
Mhm.
myself as well. When I got divorced, my part of our situation was that my ex-husband bought a house, and that gave that to me as part of the settlement.
Mhm.
And it turned out within the first year, I needed a new furnace. That's how I know how much a furnace
Yeah.
costs. Um, and a few
Yes.
other things, which meant I had to come up with tens of thousands of dollars
It's
in
so,
cash
yeah,
right away.
that you were not expecting, and it can be really, really stressful. And that's something that you're not aware of you're signing up for. So that then, you fought all this time to keep the house. Now all this stuff's happening. And then you say, shoot, maybe I should just sell it. Okay, well, guess what? Now all the fees and the realtor fees and taxes and everything associated with selling the house are just on your side of the fence now. Where
Yep.
if you ended up selling it previously with your spouse, you basically split those costs of selling the house and then you net out whatever's left, right? So,
Right.
you know,
You're so full of good points, because that's another one that I don't think people truly understand. And I'm just going to reiterate it for my listeners. If you sell the house during the divorce, then the cost of the realtor's commission and all of the various costs and fees, there are taxes when you sell a house, there are conveyance taxes, things like that. We estimate they're 8 to 9% of the sales price.
yeah,
Those are, and you're splitting the proceeds. Well, you're splitting the costs of sale as well if you're doing that during the divorce. But if you keep the house in the divorce and then sell it down the road, that 100% of those fees and costs now come out of whatever the proceeds of the sale are. Now that can be good if your house continues to appreciate in value and
yes,
equity goes up. It may be worth taking that 4.5 to 5 or whatever percent hit on
hmm,
your own. But gosh darn it, you need to know about that in part of
yeah.
your decision making, right?
Right, right. And if all of a sudden you realize that you're going to need a new roof, so you're like, I'm going to sell the house. You're like, you're double, it's a double issue for you because so making all those decisions as you're going through your negotiations and bringing in the accurate professionals to help you make these decisions. You don't have to make them on your own, but knowing what they all are is really, really, really important.
Well, and starting gathering this information and doing this analysis and generating these options as early as possible in the process, if keeping the home is something that is being considered.
Mhm.
So
Yeah.
we've said that multiple times. How would, if somebody wanted to work with you, what's the best way for someone to get in touch with you to start talking about this in the early days of your divorce, everyone?
Yes, absolutely. So I have a calendar link on my website, which is TamiWollensak.com. And, I do free consultations. My services, I do not charge for my services because I am licensed. It's against EQA and RESPA by me to charge a consulting fee. So my services are free. And I am more than happy to work with you and your divorce team on coming up with options. And then if there is a transaction, I happen to be able to do a mortgage at the end of the day if there happens to be one. So,
Well, I think that that is, a very significant thing for people to keep in mind. And I urge you, everyone out there, and I think you've heard in this episode, tips for both sides of the fence, the person who wants to keep the house and the person who may stay on the mortgage for a while so that the other person can keep the house. So it really doesn't matter what side of this you're coming in from. It can be very helpful to talk to Tami or someone who does what she does during the divorce so that you don't make mistakes and you're not like those people who come to Tami after the divorce and find themselves in a situation that they hadn't anticipated. So I urge you to reach out to her. I will put all of her contact information as well as her social media handles, etc., and links to her website in the show notes for this episode. And Tami, so many good, I call them golden nuggets, so many great golden nuggets for my listeners in this episode. The one that's a little scary is that credit report, folks. I promise to do that episode for you soon.
Yeah, that would be great. Yeah, thank you so much for having me, Susan. It was a pleasure, and I look forward to helping